Well, the Fed have put us on notice that they're about to start reasonably aggressive balance sheet reduction that's going to be phased in. We're going to see 50 basis points of hikes coming through at the next meeting potentially. Crypto starting to look vulnerable. We've seen the US dollar at the highest level since May 2020, and we're starting to find a few equity sellers as well. Markets are lively, but they could become more lively. Blake and I discuss all these factors as we assess the trade-off. Well, hi there, ladies and gentlemen. My name's Chris Weston. I'm head of research here at Pepperstone. I'm going to be joined in a second by Blake Morrow from Forex Analytics, and we're going to be discussing all the landmines and navigating all the thematics that are really front of mind at the moment, and all the setups that are just encapsulating your world of trading. And I'm going to bring Blake into the program. Welcome to the program, Blake. How you been?
Hi, Chris.
You look like a Cheshire cat, mate. So obviously something's going well for you over there at the moment. I'm not sure if the program just froze.
I just want to throw you off. I want to throw you off a little bit.
That's it, mate. It's easy to do. It's easy to do. I just think that we've seen a little bit of calmer conditions, but I think we're going to see the hallmarks are now we could see some volatility pick up again. And we'll talk about those in a second. But what's your view there? Do you think we're going to start seeing vol pick up in broad asset markets again?
I do. Actually, and that's kind of one of the topics I wanted to discuss today is just that volatility is just kind of staying at elevated levels. Yeah. And it's good. As a trader, we'd like that. But, we got to be aware of it and be on our defensive kind of posture as a result. Yeah. Right.
Well, it's obviously so important that our position sizing, the risk we're taking on is dynamic to the volatility and range and movement in the market. So if you're not adjusting it for changes in volatility, then I think you really need to look at how you consider position sizing, because it's obviously critical to surviving and thriving in these financial markets. But let's have a look at what is causing those factors. Let's go into Topical Thunder and have a look at some of the big macro and big talking points that are going through the floors at the moment. Well, mate, look, we've got crypto starting to find a few sellers, Blake. We've seen the dollar index is at the highest level since May 2020. That's been driven by what we've been seeing in front-end yields. We started to see a re-steepening of the curve. Everyone last week and earlier this week was talking about yield curve inversion, recession. But ultimately, for me now, I think we're in a really interesting point. The Fed have just told us in the minutes that they're going to get up to a terminal rate of balance sheet reduction of $95 billion a month, and that's going to be split over US Treasuries, 60 billion and 35 in mortgages. So you've got that reduction coming through. Next week, Blake, we've got an inflation number in the US. The market's expecting that to go up from 7.9 to 8.4%. For me, look, all of those recipes with a stronger dollar are quite concerning. Crude prices have started coming off, which is probably a good thing. But how are you reading sentiment on the ground in that situation there?
Well, as far as the minutes goes, I'm really surprised that number didn't shake the confidence of the market a little bit more. I mean, the market actually absorbed it pretty well.
I think the Fed have the Fed have conditioned us. I mean, they've told us about that, right? So I think their forward guidance has served quite well, right?
Yeah, it really has. But at the same time, the dollar didn't respond as well as you would have thought. The euro did fall a little bit, dropped back below 109, but you can see, here we are in early Asian trade the day after the minutes came out, the euro's popping back above 109. That means the market, like you said, they're very well prepared for what's coming at us. And, the scary thing is, as you pointed out, inflation is a concern. It is going to be something that I'm going to be talking about, because it's not just the US that I'm worried about now. I'm worried about everywhere else as well. And so we've got to start preparing for that. And we've got to start thinking about how we're going to manage our trades around, that inflationary pressure, because I don't see it abating anytime soon. How do you feel about that?
Well, there's a couple of things that scare me. First of all is next week I'm going to be in the deep outback Northern Territory at the cattle station mustering cows, and these soft financial hands are going to have to do some manual labour. So that scares me. The second thing that scares me is that real rates are moving up towards positive territory at the moment. So that is really a big situation. So if you look at 10-year nominal treasuries adjusted for expected inflation, we're at negative 24 basis points. That is moving up at a clip. And I've talked about this time and time again. It's the idea of positive real rates in the US. That is a major drag for equity returns. So we're getting closer to that tipping point for me, and I think that's where we are. But so, look, balance sheet reduction is I think as expected. But I think we combine that with a stronger dollar and positive real rates, and I think we've got some real headwinds there. Go and have a look at that article that Bill Dudley, the New York Fed president, has just put out, and an opinion piece on Bloomberg saying that inflation's going up, stock markets have to go lower. There's an article in Bloomberg. Read that, and it sort of feeds into that situation. So, yeah, capital.
I did actually. Yeah, I was going to say I did read that as well. I think that's it's something that when you got Fed presidents saying that, you've got to take notice, right?
Exactly right. So, yeah, I think that real rates keep me up at night at the moment. So one thing to lock at in terms of that.
So do you have to milk cows? I'm just asking.
No,
for a friend.
It's not a dairy farm, mate. No, I've got to walk around and sing to them and do all that sort of stuff.
Nice. Okay. Well, I'm going to take you over to volatility because volatility is on my mind. It's on my mind from a trader's perspective, from a safety perspective too. What you've noticed in the VIX is the VIX is holding up, near the high teens, low 20s. And this is a great environment for a trader. As a trader, we can, navigate through volatility. For me, it's always been a lot easier because I'm not always the best market timer intraday because whether I'm doing a webinar, whether I'm talking to, other traders, whether I'm interviewing somebody, I don't always get that precise entry. So for me, if I screw up my entries just a little bit, that volatility allows me to, get back into profitability if I might have miscalculated my timing a little bit. However, it also extends ranges too. And when ranges start to break, and we've seen it in the yen, they start to go and then you just don't know where they're going to stop. And with the euro breakdown, the yen breakdown, we've seen that all over the last few weeks. And I don't think it's going to stop. I think that volatility is going to stay elevated. And I think as traders, we need to be defensive. And this is more of I want to see how you're tackling it, but I want to warn all the traders out there. Look, this is not the time to be sizing up positions because that's a recipe to getting knocked out of the business. And that's not what we do as traders. For us, it's managing risk and chipping away and staying alive during periods like this where you have massive amounts of volatility. What do you think, Chris?
Yeah, I think volatility to me is everything in markets. There's two ways to look at this. Is actually the expected volatility or the volatility in the market, and adjust your position sizing to that. And the VIX, you could be using that. A lot of traders use realized volatility as well. The other thing is looking at your actual open positions and the daily returns that you're seeing. And the sort of swings that you're seeing there as a standard deviation or an annualized standard deviation number, and you can target a certain level. And if the volatility in your daily returns is too high, then obviously your position sizing is all out of whack as well. So yeah, volatility is really key in terms of that. Now, the VIX is at 22%. So if you divide that by 15.9, you get the expected move in the S&P. Or daily averaging over the next 30 days. And you can use that as in your equity trading. But for me, I think we probably go up a little bit higher now. I think given all the risks that we have now with liquidity withdrawal, high inflation next week, French election, maybe, comme ci, comme ça.
Yeah.
I don't think it's going to be one, but I think there's the possibility that we do see the VIX pushing up into 25%. For me, 25% is a lovely level. Below 20% on the VIX, and I think markets are pretty sanguine. They're pretty happy. Into sort of the mid 25s for me is a nice range. Above 30%, it's getting lively. Above 40%, and you've got real panic coming through in the market. That's the way I like to see it.
Good point. Yeah, and I think it's something that we've got to be aware of.
Yeah. Cool. Do you know what we're going to do, Blake? We're going to change tack because there's some good interaction last week in some of the comments that in last week's video with Tracy and one of the comments that we got, which we thought was worth addressing now. And, this is something that we can do. So if you do leave comments and want us to address it in the show, we're very happy to do so. And one of them is from Master Trader. And g'day, Chris and Blake. What's your individual bias for each of the three safe havens, the US dollar, Japanese yen and Swiss franc, for the entire second quarter? Could you please give a brief explanation for that? So Blake, probably there's two ways to look at this. First of all, what is your your outlook for this second quarter? Is there one that really stands out as having a strong bias? And secondly, as a trader, do outlooks really matter too much to you?
Outlooks don't matter to me, and I try not to do outlooks and forecasts personally, because it's not. I'm not in the business of trying to make myself, a name for myself, because I called it right over the course of the next couple quarters of a currency move. That's just not what I'm going to do as a trader.
Sure.
However, if you want my opinions about like the yen or the dollar, I think the dollar still retains its safe haven status. So if you're more worried about like, oh, let's say the S&P drops to 3,800. Are we going to see a swift move higher in the dollar? I think the dollar would be a beneficiary of that. And I actually think the Japanese yen will be too. And even the Swiss franc, if it's euro related, or let's say Ukraine related. But Japan, one thing that we've got to be a little bit weary of is you're going to start hearing some jawboning as the dollar yen is nearing that.
We've already seen that, Blake. We've seen that a few times. Yeah, even Crude has been out in the wires talking about watching currency moves and stuff.
And imagine how vocal they're going to be if we start making it towards 130. So I think just from a rubber band's a little too stretched perspective one direction, you could start looking at the yen as being more of a safe haven play in the event that we get some risk aversion. But those are my thoughts on those three safe haven currencies.
I think you make a good point on the Swiss franc. It becomes a better safe haven if the epicenter of those cause of concerns is euro related, which I think a lot of that has been at the moment. I quite like the dollar. Fundamentally, I think it's if you're going to get that equity drawdown, you're going to go into the US dollar, and that continues to be the best house on a shabby neighborhood. I think if you're looking at the rate hikes and various factors, probably the Fed have got more room to raise relative to what's priced into the Australian curve, Kiwi, Canadian, UK, for example. So I quite like that element. I think you're getting the best growth there. You're getting the highest levels of inflation. So fundamentally, do I like I think the US dollar is probably one of the better currencies out there for the second quarter. But the important thing for trading is not to fall in love with the view. Just because I think the dollar is going to go up 3-5% over the quarter, if it doesn't do that, you've got to react as a trader. You've got to trade the flow of capital, the price action you're seeing there. So I agree with you. Outlooks don't really matter unless you're investing in a currency. But for traders, we react to price moves. And if the facts change, sir, I change. So that's really what it's all about.
There you go. All right. Well, and that was a great question. I'm so glad that you guys and gals are asking questions. I personally, after these shows air, I try to jump into the comments section and get involved. So if you have any questions for myself or Chris, get down in the comments section and say something. We'll try to address it. Get involved. Okay. The next topic I really want to talk about is next week. Not only do we have inflationary data, but we do have the ECB. And I guess the question is to you, Chris, is the ECB in a pickle? I mean, you look at inflationary data throughout Europe, and it's only going to get worse the longer this situation in Ukraine persists. I don't see it getting better anytime sooner. I would like to be wrong. And somebody, please, Putin, prove me wrong. Somebody prove me wrong. But even after that, the aftermath that the Eurozone and possibly the rest of the world is going to be facing is going to be something that we got to pay attention to. I mean, you're looking at Spanish CPI is what, near 10%? Was it 9.8%?
Yeah.
I mean, that's nuts. I mean,
it's nuts.
It is nuts. So what is the ECB going to do here? Are they going to do they raise rates and cap growth, or are they going to just say let inflation continue to run hot to where it really just completely cripples the economy? My opinion, Chris, my personal opinion is the ECB is going to start becoming very hawkish because they are going to have to tackle this sooner rather than later. And then they can slow down the speed of, their rhetoric or, how quickly they actually raise rates after they head inflation off at the pass. But I'm no central banker. What do you think here?
Yeah, I agree. They are in a pickle. And I think what's interesting, if you go into the euro dollar futures curve, the interest rate markets in the US in 2024, the market's pricing in rate cuts, but they're pricing in rate hikes in Europe. And that's never going to happen. You can imagine a world where the Fed are cutting rates, but the Europeans are raising rates. That's just not going to happen. So, Yeah, I think that's one.
Euro 130.
Well, it's never going to happen, mate.
I know. I'm just saying.
Yeah, look, you've got an inflation problem in Europe, like you have in so many other places, but you've also got a consumer confidence problem. You've got a business confidence problem. If the ECB now are going to have, the first point is that they're going to have to get rid of the PPP program, the bond buying program. That could blow out Italian and sovereign spreads. You're going to see them widen against German bunds. That could be a euro negative in itself. Look, for me, also, you've got a French election, the first round coming through this weekend, this Sunday. You're very likely to see Macron facing off against Le Pen on the 24th of April. But the polls have been closing, and this was a non-issue. This was a non-event in the market's eyes. We're pricing in about 50 basis points of moves in euro dollar for the Monday open on both rounds. But now the polls have closed significantly. That it's become a market event. People have started hedging their euro exposure, CAC exposure. So that's something that we're looking at. But yeah, absolutely. I think the first point in Europe is that they've got to get rid of the PPP program. The market's pricing in 50 basis points of hikes this year to get the rate back up to zero. But yeah, that's in an environment where, business confidence and growth is slow. Got to watch Europe. It's going to be a fascinating vehicle towards the end of the year. We're going to be watching that one very, very closely indeed. But anyway, let's go to some of the charts that are on our mind. Let's go to That's a Setup. Like, I want to bring up the dollar. It's your currency. It's a very same sort of currency. Dollars all look the same to me when you got it in their paper in your pocket. You need a bit of difference in the paper, I suppose. But
be the greenback.
The greenback. Yeah, mate. We've got a bit of a breakout in our hands. I know you're going to be focused on euro dollar, and we've been talking about that. And obviously, the dollar index is 57% weighted towards the euro. But we've got a little bit of cheeky breakout going on our hands. I mean, we've seen 2-year treasuries, which have been driving the show there, moving up to 250. A lot's being priced into the curve for this year. We've got about 8 hikes being priced in. We've got quantitative tightening, which is about to be announced, running up to about $95 billion. But you've got a 50 basis point hike probably going to happen in that May meeting. It's something we're watching out. But the dollar seems to be in vogue again. Now, the question is this breakout for real? And if so, are we going to see 100 on the dollar index, something we haven't seen for a long time? And can this continue to going? I love momentum trading, but I want to see it break and just start to trend. And, the problem with momentum trading is you get lots of false starts. You get a breakout, it comes back, you get stopped out for a small loss. I really want to see this go. If it goes, I'm going with it, and I might get a small loss on the stop. But if it goes, I want to just continue following that. So it's a really interesting setup on the dollar index. What do you think?
Well, can we just fast forward 45 seconds to my next chart? I'm just kidding.
Yeah, exactly. Pretty much, isn't it?
I like the dollar where it's at right now, but I am looking to fade strength. And there's reasons behind that, which I'll talk about in a moment. But I'm just going to tell you technically, one of the things that scares me the most about the dollar index, it's facing channel resistance right above 100. It's like 125, right around there. Also, the relative strength is divergent. That means it's rallying on less strength. So, and you pointed out exactly right, Chris. This is one you have to buy dips and sell rips, and that's really the way to trade a trending market. It's moving higher, but you got to be careful not being caught up long as it's breaking out. So.
Well, I actually no, I'm the opposite of that, Blake. As a momentum trader, I think if this breaks, I'm happy to be long without targets and just continue to ride this higher. And if it rolls back and gives me a fake out, I'm cutting this out. So I love breakouts as a momentum strategy. I want to buy strong. Actually, so I take the opposite side of this. If this goes, I'm along with it, and if it cuts. But at the moment, it needs to show me something. So I'm watching this one and taking it as a momentum strategy rather than a sort of a mean reversion type move.
Well, let me show you something, Chris.
I see your hand and I raise you.
Yes, I'm going to raise you a dollar or maybe a euro. So my chart really here, this setup is positioning for the ECB. All right. Now, it says positioning toward the ECB. That's all right. You guys get what I'm trying to do here. Positioning for the ECB. So the euro is at a multi-decade since the beginning of the eurozone, or since the early 2000. It is hitting this massive trend line, and you can actually take the lows from 2007, the 2020 lows, and the 2022 lows. I think it's 2017 lows. Excuse me. Where this support is at 108. Now, ahead of a key event like the ECB, what I think is going to happen is you're going to see the euro go mid-range. You can see that red box in between the 108 and the 111 level. So we should trade back up towards 110 going into the middle of next week. You'll notice in some of the euro crosses, like the euro Aussie, might have given us a false breakdown. The euro Kiwi, kind of the same way. Euro sterling finding some support ahead of 83 pence. So, you're starting to see the euro stabilize, and I think you're going to see a little bit of euro covering going into the ECB. And I want to play it on the long side because I know I'm wrong below 108.
Yep.
And then I also believe that the ECB is going to be more hawkish. And if that's the case, the euro might trade back above 111, maybe closer to the 200-day moving average in the next few months if they become hawkish. And that's a big if. But that's why I'm looking at the other side of your dollar trade. Chris, what do you think here?
Well, I'm just doing it from momentum. I just think strength breeds strength and weakness breeds weakness. I mean, there's obviously different strategies that you can employ, but that's one. I mean, tactically, it's the risk for me is that, I think the market is, or the world is long of dollars. And I think the propensity to have a significant move higher is obviously limited by that. What I also like in the dollar capacity here is that real rates are moving in favour of dollars. So while positioning is there, if you have a look at, if you look at the 10-year real rate in the US, it wears a near 200 basis point advantage over Europe, and that to me is so bloody attractive. I think euros get sold on rallies in this environment. We might get up to that 110 level. But I think for me, as I'm just looking at that dollar move, and if it continues to go, I'm along for the ride there. So we've got a little bit of a divergence playing through there. And I think let's flip it to the next chart, because if we are going to see the dollar strength, it's going to probably be driven by equities as well. I think in a world where the equity market continues to draw down, if we were to see it break through that 44.20 level, which is that lower red horizontal support level that I've drawn there, then I think the dollar gets further love from that perspective. I know that the world loves, you could say, well, if people are selling out of US assets, then it could be dollar negative. But I think, we talked about that idea that the US dollar is still a safe haven. For me, it's probably the safe haven. The yen has not acted as a safe haven for a while. It's not been getting those sort of love. So, where do you want to be in? If we were to see risk aversion start kicking back into equity markets for whatever reason, if we break through 44.20, for me, you still want to be long dollars in that situation. So this is a chart that's really interesting, especially as we come into the 13th of April. We've got JP Morgan kicking off earnings season. We're going to see earnings coming through. We know that earnings in Q1 have been downgraded by about 70 basis points. The first consensus earnings downgrade since March 2020. Will it be a big issue? But that idea of dollar strength, quantitative tightening, aggressive rate hikes, is that good for equity markets, or is it bad? How much is discounted? Price action started to throw a few wobbles now. We got that outside engulfing yesterday. It's followed through. Do we hit that 44.20? That's the lesson we're looking there, Blake.
Chris, you remember last week I was looking at that failed. I was thinking it was going to be a failed breakout above the 4,600 level, and it has rolled over. And look, I was on an earlier podcast with a friend, and we were talking about the world economy, and especially the U.S. economy, has been on this big party since, the last 12, 13 years. And man, the Fed's just now pulling away the punch bowl. And here we are at 4 o'clock in the morning, and I've got no more party favors or whatever it is. It's going to be bad for stocks. And I'm not saying that the stock market is going to collapse, but I think we're in a big range environment, and you got to treat it as such. You got to sell rallies, and, we get back down towards 4,000, you probably want to buy the dip somewhere down there. I'm going to trade it as a range.
But you'll remember your call is the DAX is dead. The DAX is dead, said Blake.
That's right.
It's done all right.
The DAX is dead. The DAX is dead. Part 3 is coming your way soon. Well, not yet, though, because we're going to talk about the Aussie Kiwi. I'm actually showing you, Chris, a weekly chart of your beloved Australian dollar versus the Kiwi. Mm-hmm. And we are right up against really massive resistance. We got the AUDNZD next week, and we just got past the RBA this week, which, surprised the market apparently because the Aussie spiked and then faded on that. But anyway, we're past the RBA. So now we have the AUDNZD. And I know you've been a long believer of not thinking that they could be hawkish, or they can live up to expectations. But look, I think from a weekly perspective, as long as we stay below 109, 109.50, the risk is that we continue to trade in a very choppy, sloppy fashion that we've been doing for the last, how many years is that now? I mean, do we have the the confidence that we're ready to break out higher in the Australian dollar versus the Kiwi. What are your thoughts with this chart?
Yeah, I mean, it's one that comes on the radar. I mean, we don't see a lot of people looking to trade this because it's low beta and it's boring in some people's eyes, as you say there. It's like euro sterling. It has these kind of low grinds. You'd rather trade cable. But yeah, I mean, that downtrend, if it breaks, is something that will get a bit of attention. I have no doubt about that. Next week, you talk about the AUDNZD meeting. We've got a 50% chance of a 50 basis points. It makes a very tactical situation. We don't like telling people to go and trade around announcements over news and central bank meetings because it's very outside of your control. Sure. It's not really trading. It's just getting that instant gratification of a big move akin to gambling sort of stuff. But I think tactically, we only get 25 basis points. I don't think we're 50. So it suggests to me that Aussie Kiwi's probably got some upside in that regard. The RBA's out of the way. I really like what we're seeing in Australia now. Excuse me. But yeah, I think tactically it feels that we only get 25. So from a pure rates perspective, I think Aussie Kiwi can go higher. That says, like you say, look at the RSI there. Look at all the technicals. It's overloved, overdone. But yeah, I think from a rates perspective, I think we've probably got some upside from that perspective. So it'd be interesting to see how that goes next week. But anyway, let's go.
You notice, wait, real quick. I noticed a Freudian cough there when you said things in Australia are great.
Hey, they're good.
Did that slip? I caught it.
We're good, man. We've got housing prices are starting to cool a little bit, but the unemployment's looking really, really good at the moment. The household spending's pretty good. Yeah, inflation's on the rise, but it's not as bad as like you guys have got it at the moment when you can see 8.4%. The RBA are very happy about the way that the economy's going post Omicron. So yeah, I think life's there's obviously people doing it tough, but I think generally on the whole the economy's in pretty good shape at the moment. So there we go.
I'm just checking.
Just an old man's cough more than anything else. Anyway, let's go to play of the day. See what's on our mind. Right, look, I'm going to start the proceedings off here with a cheeky short crypto situation. Now, I'm not bullish or bearish on crypto over a longer period of time. I just think these are fantastic trading instruments. Now, if you have a look at that idea of quantitative tightening, liquidity coming out of the system, this idea of dollar strength playing through, a bit of risk playing throughout the market. Now, if you have a look at the setup, we've broken the series of higher highs. That uptrend is now over. So it doesn't necessarily mean we're going to collapse, but it does mean that the trend is broken. We've seen that big move down through the prior series of highs that you've been seeing there. I think the first stop is 42,000, which isn't a huge sort of downside situation. But I think if we were to break that level, then I'd be looking to add for potentially a move down to 38,000 in that situation, as that trend, that sort of FOMO move just kicks in there as well. So I think if you look at what we're seeing in the S&P, a load of the a few of the other sort of risk proxies that we're seeing as liquidity is coming, as we go into that May FOMC meeting, the inflation numbers next week in the US, if we do see the VIX pushing up into 25%, I think that crypto is going to be that high beta anti-risk proxy. And I think we see a move down to 42,000. I think we potentially break that level, and then I think you add to the positions for a move to 38,000 there.
Chris, I have to say that when you say numbers, and I'm already thinking the same numbers in my head, like 42,000 being a downside target, that's what I was talking about earlier today with my traders, then that means it's a pretty important area. And I love it when your brain and my brain are syncing like that. So that's
from another
great.
Mother, mate.
That's right. Okay, let's take a look at crude, because it's getting a little rude here, Chris. And yeah, I know, hey, look, I'm actually very bullish crude, and I really would like to find a dip. And I think dips are going to be very short-lived at this stage in the game. And now that crude's getting a foothold below that trend line, I'm a little nervous for the longs, because I think that the risk is, now that we're down below 100, you might see some selling, maybe pick up towards 93 and take us all the way down to 89. However, that's a 618 retracement. And I think that is going to be a good area to have maybe some outstanding orders, maybe put in an order with some stops, looking for a little dip. And like I said, I don't think dips are going to be I think they're going to be short-lived. So, you're going to get stabs lower, maybe into the mid 80s, but I think that those high 80 levels are going to offer buying opportunities to get right back above 100. But that's kind of how I'm approaching crude. I want to be bullish, but I know that you have to be defensive, at least in the next couple of trading sessions.
Well, I think your boy Biden's going to be loving that, to be honest. If he can get gasoline prices lower, if he can get crude prices lower, It gives them somewhat of a tailwind going into those midterms a little bit later on. I think he'd be loving the fact that we're well off the highs on that at the moment. Anyway, so much going through financial markets. It's great to share my thoughts with Blake and pick his brain, and obviously some of the questions that you've been putting down. Please go again back into the comment section. Leave your comments, leave your questions, leave your thoughts on what's going on, and we'll answer them where we can and continue to build this growing community that we've got here. Anyway, until next week, let's hope the volatility stays alive and see the opportunities that are brewing there.